what made you switch from final expense to mortgage protection? Because everybody knows this, I'm not a huge final expense fan at all. But for the people that still do final expense, which isn't really a whole lot of people, but there are still some.
Yeah.
What was the reason that you transitioned?
The reason that, I mean, there's a couple different reasons. So, number one, when you're looking at a demographic of people that are looking to protect their some people's largest asset is their home. So, not only did I have the experience in that realm of coming from the mortgage industry, which of course helped me with some things, but you don't need to have experience in mortgage to run mortgage protection to be successful at that. With mortgage protection, you're going to have people that are having a little bit more skin in the game, I think, when it comes to the insurance, because it's something that they're living in, day out. Like I said, it's a lot of people's biggest asset that they're protecting. If they become sick and they pass, or if they become sick and they can't work, or if they pass away and then their family is left with that debt. When somebody passes away, it's not like, oh, the mortgage lender says, oh, don't worry about the payments or, anything like that. Like that is still due every single month. So people are much more inclined, I think, to put money towards insurance for something that is an asset that they're protecting. Number two, it's typically higher premiums because you're still doing term and whole life. But if you're covering something that is $300,000, $400,000, $500,000, you're going to have higher premiums. It's automatically a lower chargeback rate as well, which is going to give you more retention. And then the other thing is that when you're comparing it to people that are putting money into insurance for a protection of whenever the time comes and they pass, and then it's paying for something that they're no longer even here to kind of see, like, come to an endpoint and actually pay out, that's always going to be the first thing that they cancel. When times get tough, they lose their job, whatever it is, people in that type of mindset, on the other front, they're still going to be wanting to protect their home, which people still do, cancel their insurance for mortgage protection. But I would say that the chargeback rate is probably 5 to 10% less, depending on your skill set and how you are with your clients and building, rapport and all that kind of stuff. But so that was kind of the main reason that I had done it. I was looking to scale my business and also have like more tools in my tool belt. I wanted to be able to know how to run different types of leads. And I also think that the client experience is, like, for the agent, is just a little bit smoother, as far as a lot of times, for example, something simple, but if you have a mortgage, you have to have a bank account. You're not dealing with people that are, really using like Chime, or they only have a direct express card. Usually you're also dealing with people that are still working. So it's a little bit younger of a clientele versus final expense. You're typically looking at people that are between the ages of 60 and 80, if you will, in most cases. So it was just kind of an overall better experience and just something that I wanted to tap into. Sometimes, and this is dependent on a lot of different factors, but when agents first come into the industry, in most cases, final expense is going to be your cheapest route of investment to go. So that's why a lot of people start there. But you also, a lot of times, are going to have a lot better outcome with mortgage protection, as far as like lower chargeback rate, higher premiums, all of that. So I was just at a point where I was like, I'm over final expense. I want something new. I want something different. And like I said, I was looking to scale my business, and I felt like that was the quickest way to be able to do that.